Welcome to Crypto Red. Today I'm reading highlights from the SEC's Director of the Division of Corporation Finance, William Hinman, in a speech titled, Digital Asset Transactions, When Howie Met Gary Plastic. Given the 14th of June, 2018 at the Yahoo Finance All Markets Summit, Crypto. And I quote, "To start, we should frame the question differently and focus not on the digital asset itself, but on the circumstances surrounding the digital asset and the manner in which it is sold. To that end, a better line of inquiry is, can a digital asset that was originally offered in a securities offering ever be later sold in a manner that does not constitute an offering of a security? In cases where the digital asset represents a set of rights that gives the holder a financial interest in an enterprise, the answer is likely no. In these cases, calling the transaction an initial coin offering, or ICO, or a sale of a token, will not take it out of the purview of the US securities laws. But what about cases where there is no longer any central enterprise being invested in, or where the digital asset is sold only to be used to purchase a good or service available through the network on which it was created? I believe in these cases the answer is a qualified yes. I would like to share my thinking with you today about the circumstances under which that could occur. I will begin by describing what I often see. Promoters, in order to raise money to develop networks on which digital assets will operate, often sell the tokens or coins rather than sell shares, issue notes, or obtain bank financing. But, in many cases, the economic substance is the same as a conventional securities offering. Funds are raised with the expectation that the promoters will build their system and investors can earn a return on the instrument, usually by selling their tokens in the secondary market. Once the promoters create something of value with the proceeds and the value of the digital enterprise increases. When we see that kind of economic transaction, it is easy to apply the Supreme Court's investment contract test first announced in SEC v. Yahoo. That test requires an investment of money in a common enterprise with an expectation of profit derived from the efforts of others. And it is important to reflect on the facts of Yahoo. A hotel operator sold interests in a citrus grove to its guests and claimed it was selling real estate, not securities. While the transaction was recorded as a real estate sale, it also included a service contract to cultivate and harvest the oranges. The purchasers could have arranged to service the grove themselves, but, in fact, most were passive, relying on the efforts of Yahoo and the Health Service, Incorporated for a return. In articulating the test for an investment contract, the Supreme Court stressed, form is disregarded for substance and the emphasis is placed upon economic reality, so the purported real estate purchase was found to be an investment contract. An investment in orange groves was in these circumstances an investment in a security. Just as in the Yahoo case, tokens and coins are often touted as assets that have a use in their own right, coupled with the promise that the assets will be cultivated in a way that will cause them to grow in value, to be sold later at a profit. And, as in Yahoo, where interests in the groves were sold to hotel guests, not farmers, tokens and coins typically are sold to a wide audience rather than to persons who are likely to use them on the network. In the ICOs I have seen, overwhelmingly, promoters tout their ability to create an innovative application of blockchain technology. Like in Yahoo, the investors are passive. Marketing efforts are rarely narrowly targeted to token users. And typically at the outset, the business model and very viability of the application is still uncertain. The purchaser usually has no choice but to rely on the efforts of the promoter to build the network and make the enterprise a success. At that stage, the purchase of a token looks a lot like a bet on the success of the enterprise and not the purchase of something used to exchange for goods or services on the network. The digital asset itself is simply code. But the way it is sold as part of an investment, to non-users, by promoters to develop the enterprise can be, and, in that context, most often is, a security because it evidences an investment contract. And regulating these transactions as securities transactions makes sense. The impetus of the Securities Act is to remove the information asymmetry between promoters and investors. In a public distribution, the Securities Act prescribes the information investors need to make an informed investment decision, and the promoter is liable for material misstatements in the offering materials. These are important safeguards, and they are appropriate for most ICOs. The disclosures required under the federal securities laws nicely complement the high investment contract element about the efforts of others. As an investor, the success of the enterprise and the ability to realize a profit on the investment turns on the efforts of the third party. So learning material information about the third party, its background, financing, plans, financial stake and so forth is a prerequisite to making an informed investment decision. Without a regulatory framework that promotes disclosure of what the third party alone knows of these topics and the risks associated with the venture, investors will be uninformed and are at risk. But this also points the way to when a digital asset transaction may no longer represent a security offering. If the network on which the token or coin is to function is sufficiently decentralized where purchasers would no longer reasonably expect a person or group to carry out essential managerial or entrepreneurial efforts, the asset may not represent an investment contract. Moreover, when the efforts of the third party are no longer a key factor for determining the enterprise's success, material information asymmetries recede. As a network becomes truly decentralized, the ability to identify an issuer or promoter to make the requisite disclosures becomes difficult and less meaningful. And so, when I look at Bitcoin today, I do not see a central third party whose efforts are a key determining factor in the enterprise. The network on which Bitcoin functions is operational and appears to have been decentralized for some time, perhaps from inception. Applying the disclosure regime of the federal securities laws to the offer and resale of Bitcoin would seem to add little value. And putting aside the fundraising that accompanied the creation of Ether, based on my understanding of the present state of Ether, the Ethereum network and its decentralized structure, current offers and sales of Ether are not securities transactions. And, as with Bitcoin, applying the disclosure regime of the federal securities laws to current transactions in Ether would seem to add little value. Over time, there may be other sufficiently decentralized networks and systems where regulating the tokens or coins that function on them as securities may not be required. And of course there will continue to be systems that rely on central actors whose efforts are a key to the success of the enterprise. In those cases, application of the securities laws protects the investors who purchase the tokens or coins. I would like to emphasize that the analysis of whether something is a security is not static and does not strictly adhere to the instrument. Even digital assets with utility that function solely as a means of exchange in a decentralized network could be packaged and sold as an investment strategy that can be a security. If a promoter were to place Bitcoin in a fund or trust and sell interests, it would create a new security. Similarly, investment contracts can be made out of virtually any asset, including virtual assets, provided the investor is reasonably expecting profits from the promoter's efforts. What are some of the factors to consider in assessing whether a digital asset is offered as an investment contract and is thus a security? Primarily, consider whether a third party, be it a person, entity or coordinated group of actors, drives the expectation of a return. That question will always depend on the particular facts and circumstances, and this list is illustrative, not exhaustive. 1. Is there a person or group that has sponsored or promoted the creation and sale of the digital asset, the efforts of whom play a significant role in the development and maintenance of the asset and its potential increase in value? 2. Has this person or group retained a stake or other interest in the digital asset such that it would be motivated to expend efforts to cause an increase in value in the digital asset? Would purchasers reasonably believe such efforts will be undertaken and may result in a return on their investment in the digital asset? 3. Has the promoter raised an amount of funds in excess of what may be needed to establish a functional network? And, if so, has it indicated how those funds may be used to support the value of the tokens or to increase the value of the enterprise? Does the promoter continue to expend funds from proceeds or operations to enhance the functionality and/or value of the system within which the tokens operate? 4. Are purchasers investing, that is seeking a return? In that regard, is the instrument marketed and sold to the general public instead of to potential users of the network for a price that reasonably correlates with the market value of the good or service in the network? 5. Does application of the Securities Act protections make sense? Is there a person or entity others are relying on that plays a key role in the profit making of the enterprise such that disclosure of their activities and plans would be important to investors? Do informational asymmetries exist between the promoters and potential purchasers investors in the digital asset? 6. Do persons or entities other than the promoter exercise governance rights or meaningful influence? While these factors are important in analyzing the role of any third party, there are contractual or technical ways to structure digital assets so they function more like a consumer item and less like a security. Again, we would look to the economic substance of the transaction, but promoters and their counsels should consider these and other possible features. This list is not intended to be exhaustive, and by no means do I believe each and every one of these factors needs to be present to establish a case that a token is not being offered as a security. This list is meant to prompt thinking by promoters and their counsel, and start the dialogue with the staff. It is not meant to be a list of all necessary factors in a legal analysis. 1. Is token creation commensurate with meeting the needs of users, or, rather, with feeding speculation? 2. Are independent actors setting the price, or is the promoter supporting the secondary market for the asset or otherwise influencing trading? 3. Is it clear that the primary motivation for purchasing the digital asset is for personal use or consumption, as compared to investment? Have purchasers made representations as to their consumptive, as opposed to their investment, intent? Are the tokens available in increments that correlate with a consumptive versus investment intent? 4. Are the tokens distributed in ways to meet users' needs? For example, can the tokens be held or transferred only in amounts that correspond to purchasers' expected use? Are there built-in incentives that compel using the tokens promptly on the network, such as having the tokens degrade in value over time, or can the tokens be held for extended periods for investment? 5. Is the asset marketed and distributed to potential users or the general public? 6. Are the assets dispersed across a diverse user base or concentrated in the hands of a few that can exert influence over the application? 7. Is the application fully functioning or in early stages of development? Thanks for watching. Read to you again next time.